Hello, I'm Sebastian. Welcome to Nine Nar Trees podcast. Today, I will summarize and review the book. The Little Book of Common Sense Investing presents John C. Bogle's enduring case for a simple, evidence-based approach to building wealth in the stock market. As the founder of Vanguard and a leading voice for everyday investors, Bogle argues that most people do not need complex strategies, constant trading, or expensive professional management to reach long-term goals. Instead, he highlights how costs, taxes, and emotional decision-making quietly erode returns, often causing investors to underperform the very market they are trying to beat. The book explains, in plain language, why broad, low-cost index funds can deliver a dependable share of market growth while avoiding many pitfalls of speculation. Bogle also connects investment returns to business fundamentals, encouraging readers to focus on what can be controlled rather than predicting short-term market movements. Compact but practical, it is both a philosophy and a playbook for disciplined, long-horizon investing. I will give you key takeaways from this book. Firstly, why index investing works when most active strategies fail. A central message is that beating the market is far harder than it appears, especially after expenses. Bogle frames the market as a collective of all investors, meaning that before costs, the average investor earns the market return. After costs such as management fees, trading commissions, bid-ask spreads, and taxes, the average investor must earn less than the market. This arithmetic is not a prediction but a structural reality. The book contrasts the promise of active management with the practical obstacles, manager selection risk, frequent turnover of strategies, and the tendency for top-performing funds to regress toward the mean. It also highlights how performance advertising can emphasize short windows that do not persist. Indexing, by design, accepts the market return and focuses on capturing it efficiently. A broad index fund provides instant diversification, reduces the impact of any single company failure, and avoids the need to forecast which sectors or managers will win next. The outcome is not guaranteed riches, but a high probability of receiving a fair share of long-term stock market growth. Secondly, costs and compounding, the silent drag on lifetime returns. Bogle repeatedly returns to a practical truth: what you pay matters, and the damage compounds over time. Even seemingly modest annual fees can consume a large share of an investor's lifetime gains because they reduce the base on which future returns compound. The book draws attention to the many layers of cost embedded in investing, including fund expense ratios, portfolio turnover, leading to trading costs, sales loads, advisory fees, and taxes triggered by frequent buying and selling. Importantly, these costs are certain, while future returns are uncertain. By minimizing the certain negatives, investors improve their odds without needing superior forecasting skill. The common sense approach emphasizes choosing low-expense, broadly diversified index funds and maintaining tax efficiency by limiting turnover. It also encourages scrutiny of product complexity, since complicated strategies often come with higher fees and less transparency. Over decades, the gap between a low-cost and high-cost approach can become the difference between meeting retirement goals and falling short. The book's cost focus is not about frugality for its own sake, but about maximizing the investor's share of what markets already provide. Thirdly, staying the course through market cycles and investor psychology. Another major theme is behavior. Even a sound strategy can fail if an investor cannot stick with it. Bogle discusses how fear and greed tend to push investors into chasing recent winners near market peaks and abandoning stocks during downturns. These mistakes can be more damaging than picking the wrong fund because they turn volatility into permanent loss by buying high and selling low. The book advocates a disciplined, long-term mindset that treats market declines as normal and temporary features of equity investing. It suggests creating an allocation that matches one's ability and willingness to take risk, then maintaining it with periodic rebalancing rather than reactive trading. This approach reduces the temptation to time markets and converts volatility into a manageable process. Bogle also stresses the value of simplicity, since complex strategies can encourage constant monitoring and tinkering. By focusing on a steady plan, diversified exposure, and low costs, investors can better endure inevitable bear markets. The reward for patience is not the absence of turbulence, but the ability to participate in long-term market growth without self-sabotage. Fourthly, linking returns to fundamentals, what drives stock market outcomes. Bogle distinguishes between the long-term economics of investing and the short-term emotions of speculation. Over time, stock returns are grounded in business fundamentals, such as dividend income and earnings growth, while changes in valuation levels can amplify or reduce returns over shorter periods. This framework helps readers set realistic expectations and avoid narratives that markets are purely random or purely predictable. By understanding that the market's long-run reward comes from the productive capacity of companies, investors can focus on owning the market rather than trying to trade it. The book also uses this fundamentals lens to explain why periods of exuberant valuations can lead to lower future returns and why depressed valuations can improve future prospects without turning that insight into a market timing scheme. The practical takeaway is to respect uncertainty, diversify broadly, keep costs minimal, and allow compounding to work. Fundamental thinking supports the index approach because it emphasizes broad participation in corporate growth rather than dependence on identifying a handful of future stars. It also reinforces the importance of patience, since fundamental progress unfolds over years, not weeks. Lastly, building a simple portfolio and setting realistic expectations. Beyond philosophy, the book points readers toward a straightforward implementation. Hold diversified, low-cost index funds and align the mix of stocks and bonds with personal goals. Bogle emphasizes that the right allocation is the one an investor can maintain through stress, since abandoning a plan during a downturn can be more harmful than choosing a slightly imperfect mix. A balanced approach can reduce volatility and provide a smoother path for investors who may otherwise panic. The book encourages long horizons, consistent saving, and avoidance of unnecessary complexity, suggesting that investors should concentrate on the few decisions that truly matter: savings rate, asset allocation, costs, and discipline. It also cautions against overconfidence in forecasts, hot themes, or frequent changes based on headlines. By keeping expectations grounded and focusing on controllables, investors can measure success by progress toward goals rather than by beating an index in any given year. The end result is a portfolio designed for durability. It aims to capture market returns efficiently, support long-term compounding, and free the investor from the constant pressure to outsmart other market participants. In conclusion, this book is best suited for long-term investors who want a clear, practical framework for building wealth without becoming full-time market analysts. Beginners will appreciate the straightforward explanation of how markets work and why many popular tactics underperform after costs. Experienced investors and professionals can benefit from the disciplined reminder that simplicity, diversification, and low expenses are not beginner ideas, but enduring advantages. The book can improve a reader's life by shifting attention to controllable factors, saving consistently, choosing an appropriate stock and bond mix, minimizing fees and taxes, and staying calm during market turbulence. These habits support better financial outcomes while reducing stress and decision fatigue. Compared with many investing titles that focus on stock picking, tactical timing, or complex products, Bogle's approach is designed to be repeatable and resilient across market regimes. It also stands out for grounding its argument in basic arithmetic and long-run fundamentals rather than trends or sensational predictions. For readers seeking a plan that prioritizes probability over excitement, it is worth buying because it offers a durable philosophy and an actionable path that can be implemented with a small number of low-cost funds. If you would like to support John C. Bogle, you can buy the book through the Amazon link I've provided in the podcast description. After reading the book, please let me know what you think and share your thoughts. See you around.